Quick question. When you put $100 in the bank, how much of that money actually exists? I'm gonna guess your answer is $100, obviously. And that's exactly what you're supposed to think. Here's the twist. Banks don't just store your money, they multiply it, legally, out of thin air. One deposit can turn into $1,000, $10,000, sometimes more, without a single new bill being printed. This is fractional reserve banking, and it's literally how modern money creation works and how banking stays alive. By the end of this video, you'll know exactly how banks create money and why what you were taught is backwards. Stick around, because the last part is the part banks really don't want going viral. Let's get into it. Okay, so let's start embarrassingly simple. Pretend you and I live in a tiny village with no bank yet. Everybody keeps their cash under a mattress in a coffee can. Very secure. Very smelly, probably. Now let's say I open the first bank in town. Big sign out front, a vault, the whole deal. I tell everyone, bring me your cash, I'll keep it safe, and I'll even pay you interest for it. You bring me $100. I lock it in the vault. $100 goes in, 100 sits there. That's the story most of us grew up believing about banks. They're just really secure piggy banks. But here's the part they don't explain in school. I'm a business. I don't make money by just staring at your cash. I make money by lending it out and charging interest. So are you really going to ask for all 100 back tomorrow? Probably not. Most days you take out $10 for groceries. So why let $90 sit there doing nothing? This is where fractional reserve comes in. Fractional just means a fraction, a piece, not the whole thing. Instead of keeping all $100, I keep a fraction, say 10%, as a reserve just in case. The other $90? I lend it to your neighbor Tom, who wants to open a taco stand. Tom pays his supplier, who deposits that $90 into his bank. That bank now has 90 new dollars. That bank keeps a fraction as reserve too, say $9, and lends out the other 81. And it ripples again. So from your original $100, the banking system can create hundreds of dollars in new loans, ripple after ripple. Economists even have a formula for this, the money multiplier, roughly 1 divided by the reserve ratio. If banks must hold 10% in reserve, the theoretical multiplier is 10. $1 can support 10 in deposits. Your $100 basically became a small economy, tacos, suppliers, new spending, all from one deposit. Real quick, before I tell you that story's kind of outdated, this channel breaks down confusing money stuff like this. If that sounds like your thing, hit subscribe and drop a like. It genuinely helps this channel grow. Okay, now the good part. So here's what blew my mind. That vault story, it's a simplified teaching model. Central banks have said so. In 2014, the Bank of England published Money Creation in the Modern Economy, and it says the popular story is backwards. Here's what actually happens. When a bank approves your loan, it doesn't dig into other people's deposits and hand you cash. It creates a brand new deposit in your account on the spot, with a couple keystrokes. New money, out of nowhere. The loan and the deposit are created simultaneously, just a bank's accounting entry, appearing instantly. So what happened to the reserve requirement thing? Here's a fact that genuinely surprises people. In March 2020, the Federal Reserve cut U.S. reserve requirements all the way down to 0%. Not 10, 0. That's still the rule today. So the neat reserve ratio formula from before doesn't even technically apply anymore. So what stops a bank from creating infinite money and lending to everybody? A few real limits keep this in check. Capital requirements. Banks must hold a cushion of their own money to absorb losses if loans go bad. Profitability and risk. A bank only wants to lend to people likely to pay it back. Bad loans mean real losses. Central bank policy. Raising interest rates makes borrowing expensive, slowing new money creation. That's the main inflation lever. And the need for actual cash. Banks still need enough liquid funds to cover withdrawals every single day. So the honest summary, banks create money the instant they issue a loan, then manage reserves afterward to stay stable. It's less fixed formula robot and more bank constantly managing risk in real time. Now here's why that actually matters. This exact system is why bank runs are terrifying, and not just old black and white movie history. If a bank has created way more in loans than it has in liquid cash, and everyone shows up wanting cash out, the bank can literally run out of physical money, even though every account balance looks fine on paper. That's exactly what happened to Silicon Valley Bank in March 2023. Depositors pulled $42 billion in a single day. It became the third largest bank failure in US history, and about 89% of its deposits weren't even insured. This is also exactly why deposit insurance exists. In the US, that's the FDIC, insuring deposits up to $250,000 per bank. That's not charity. It's a patch for a system that, by design, cannot pay out everyone's money all at once. And here's the bigger point. This is basically the origin story of booms, busts, and inflation itself. When banks lend freely, new money gets created fast and the economy heats up. When banks pull back, it can freeze overnight. The banking system isn't just storing the economy's money, it's one of the primary engines creating and destroying it. So back to my first question. When you deposit $100, how much of that money actually exists? Your $100 is real, but the system lets banks create way more on top of it than physically exists anywhere. It's not a scam or a conspiracy. It's a regulated design choice that keeps modern economies moving. But the comforting image of a banker locking your cash in a vault? Honestly, that part's basically a fairy tale. And that's how banks actually create money, not by hoarding your cash, but by conjuring deposits every time they lend. If your brain just did a little "wait, what" moment, tell me exactly where in the comments. I read every one. If this finally made fractional reserve banking make sense, smash that like button so more confused people find it. Share this with the one friend who thinks their bank just keeps their money in a little drawer with their name on it. And if you want more of this, plain language breakdowns of confusing financial stuff, subscribe. I've got more coming. See you next time.